Hello everyone, welcome to a professional US stock channel that not only talks about international news, digital currencies, AI technology, and other topics every day, but also provides daily updates for everyone. I am Aji. These past few days, the market has been relatively calm. In fact, everyone has been wanting me to talk about the real estate market in Canada and the United States, taking advantage of today's news. Let's thoroughly discuss the real estate market in Canada and the United States. Without further ado, let's take a look at the trend of asset prices on Tuesday. The US dollar index and US bond yields have experienced a slight decline, and TOT has also fallen. This means that the long-term US bond yields have rebounded slightly. But the major index has experienced a wave of rally before the closing, and I don't know what the reason is. So the S&P 500 rose 0.4. The Nasdaq rose 0.4 and the Dow Jones Industrial Average rose 0.3 before the close, which was quite comprehensive. Gold also rose by 0.7, Bitcoin rose by 1.5 and Russell 2000 rose by 0.8%. So Tuesday's overall market rebound was still good. The price of crude oil has dropped by 2.2%. From the perspective of sectors, some sectors have experienced a decline, but most sectors have still seen an increase. In the early stage, major technology stocks rose by 4 and the equity index rose by 0.1. I would like to mention that the banking sector has risen by 1.3%, and the overall IT of the banking sector has also increased by 18. Today, I posted a tweet specifically about reviewing the beginning of the year. Why did I plan to expand into the banking sector and what did I focus on? So far, it has actually been verified that the beta of the banking sector is not that high. In the case where the S&P 500 only rose by 10, the banking sector was able to break through the 18% increase, which is actually very good, ranking second among all sectors. Additionally, there is one thing I would like to mention about the banking sector. It is a sector within an economic cycle, which is very close to the economic cycle. In the case where the banking sector performs very well, it is obvious that there is no recession in the capital market if you see that the recession is somewhat similar to April. And Trump's tariff policy was formulated in April. You clearly see the possibility or increasing likelihood of a recession. So the decline in the banking sector in April was not small. In the past period, the rebound of the banking sector has been significant, which indicates that the market has not actually experienced a possible decline in pricing in the future, or the market does not believe that a decline will occur. Another aspect related to real estate is that yesterday Trump fired Federal Reserve Governor Lisa Cook, which has raised concerns in the market about the Fed's independence. In fact, there are some indicators that we can refer to when measuring the Fed's independence, including an index of Fed independence in the market. We call it index, which has 4 components. The first component is Taylor's law, whether the Federal Reserve has implemented their monetary policy in accordance with Taylor's law. Taylor's law is purple here. We can see that in 2022, 2023, and 2024, the purple color on the Taylor's law side is negative, which means that in these years, the Federal Reserve did not formulate their monetary policy or cut or raise interest rates based on one of the guidelines of Taylor's law, so this area is negative. So the Federal Reserve did not approach it from the perspective of Taylor's law. The Federal Reserve does not have independence on that side, which is why it is negative on the purple side, or in other words, a negative independence index for the Federal Reserve. This is the first perspective. The second perspective is called success in anchoring inflation expectation, which refers to whether the Federal Reserve has prioritized inflation expectations. The light blue line in the picture and the bar-shaped structure of BAU in light blue has always been positive, indicating that it is suppressing market expectations of inflation. In this regard, the Federal Reserve has actually done a good job. On the yellow side of the third part, there is public support for the Fed. The market or society as a whole has had a very negative support for the Fed in recent years. The whole market of the Federal Reserve has always believed that the Federal Reserve is not independent. To be honest, this period of time was not after Trump, but also after Biden, most of the time when Biden was in office. The market did not believe that the Federal Reserve was independent even when Biden was in office. This is very interesting. When Biden was in office, the market did not think that the Federal Reserve was independent. Those who stood by Trump believed that the Federal Reserve deliberately cut interest rates before the election to help Biden or help the left to be re-elected. It seemed that people inside and outside were not human, right? When Biden was in office, the entire market did not believe that the Federal Reserve had this independence. And at the same time, people on the right did not believe that the Federal Reserve had this independence, which means that neither side is human anymore. This is the third part, and the fourth white bar represents whether the existing government has intervened with the Federal Reserve. If there is intervention, it means the independence of the Federal Reserve is negative. And if there is no intervention, it means the independence of the Federal Reserve is positive. So in the past few years, the white bars have always been positive, indicating that at least the Biden administration has not intervened too much in the Federal Reserve. In the recent past year, I saw that white is negative. That is, in the 2 quarters after Trump took office. The government's intervention in the Federal Reserve was clearly understood by the market as affecting the independence of the Federal Reserve. So after all these aspects of these indexes are added together, we can see that in 2022 and 2023, the market did not think that the Federal Reserve had this independence. The two main negative contributions are that the Federal Reserve itself has not formulated its monetary policy based on Taylor's law. The pink area is very clearly negative. The second point is that the orange market has a lack of trust in the Federal Reserve. So in the past 2 years, the market has not believed that the Federal Reserve has this independence. Now that Trump is in power, if you add everything together, it may be a little better than 2022 and 2023, even though the government has a significant impact on the Federal Reserve. As for the impact of the Federal Reserve losing its independence on asset prices, I discussed it in yesterday's video and I will summarize it very quickly. On X, I also talked about it today. There may be risks in the short term because it cannot be ruled out that Wall Street can speculate. This storyline can be reflected in the decline of the stock market, bond market, and foreign exchange market, which is the triple kill of the stock, foreign exchange, and bond markets. But from a medium-term perspective, a dovish Federal Reserve is a proof of its role in asset prices. From a long-term perspective, if inflation rebounds due to an overly dovish Federal Reserve. At that time, I didn't think that Trump would still insist on letting the Federal Reserve cut interest rates or become dove because I thought that Trump was a realist. Or that the team behind Trump Besant was very realistic and he could accurately grasp what the market needed now. Let's talk about the real estate market. Let's first take a look at the real estate market in Canada. Firstly, the image on the left shows the overall housing market in Canada. When will the Canadian real estate market peak at this composite price? February and March of 2022 have been almost continuously declining until now. The magnitude of the decline in the past 2 years or this price has actually flattened or is still falling. But it has flattened, at least not as large as the decline in 2022. But we see that the overall Canadian real estate market has maintained an upward trend from 2025 until now. Why does it still maintain an upward trend? Including the future, why? I think we can continue to maintain this upward trend. I will talk about some of my own opinions later. The right detached house is also the same. It has been on an upward trend for a long time. But the magnitude of the increase in 2020 and 2021 was too exaggerated, so it will be repaired starting from 2022. To be precise, the 3.5 years from 2022 to 2025 have been a process of repair. Why don't I think Canada's real estate market will explode or plummet? It is because the first and most important reason is that Canada is an immigration country. And a large part of Canada's real estate depends on whether immigration policies are loose or tight. About a year ago, the Canadian government began to decide to tighten their immigration policies. Why tighten? It's because too many immigrants will be released in 2022. 2023 and 2024, especially those from India. Why did we turn a blind eye and release immigrants at that time? Why do we need to accommodate both short-term and long-term residents? Because we need to address the labor market. At that time, the mainstream voice in the global market caused inflation due to the shortage of labor market. How can we solve the shortage in the labor market? When we open immigration, we see that by the end of 2024, The Canadian government has decided or formulated immigration policies for the next 3 years, 2025, 2026, and 2027. We see that there are two types of immigrants in total. One is short-term residents, one is a long-term resident. In terms of short-term residents, it is expected that the total net population of 60 short-term residents in 25 years will increase by 673,000 and will directly shrink to 516,000 or 517,000 by 2026. In 2027, there will be a slight rebound on the basis of 2026 and from 2025 to 2026. The main decline comes from the international project called IMP. We see a decrease from 285,000 to 129,000. And where is the main focus of this IMP project? We call it a postgraduate work permit, which is a work visa for you after graduation. I have read a lot about this. So unfortunately, if I graduate in 2026, it may become difficult to obtain this work visa after graduation. But on the other hand, I have discussed this issue with some viewers in Canada. On the contrary, now is actually the best time to immigrate to Canada and study there. Why? Because you are here to study now, you will not graduate until 4 or 5 years later. When I graduate in 4 years, I believe that the immigration policies at that time will be much more relaxed from 2025 to 2029. Therefore, from the perspective of student visas, they have not been cut, but they have not increased either. We are still preparing to issue 306,000 student visas every year. From the perspective of immigration, there has also been a slight reduction. The expected decrease in the number of short-term residents from 395,000 in 2025 to 380,000 in 2026 and 365,000 in 2027, as well as the decrease in the number of immigrants, will directly affect housing prices and the underlying demand. So that's why in the past period, the total immigrant population has actually slowed down from 2024 to 2025. That's why even though the Bank of Canada has been cutting interest rates throughout 2025 and 2024, there hasn't been any improvement in housing prices. In the future, I believe that when the Canadian government opens up again, especially for temporary residents, if there is growth from 2026 to 2027, the real estate market will actually experience a rebound in 2027, which I think is in anticipation. Even a rebound in September and October in the second half of 2026 can be expected. On the US side, today I saw a big V from abroad posting an X. He said, "Home prices are in free fall across us." The real estate market has experienced a free fall in prices in the US, but the picture below shows a year-on-year growth rate, so he made a mistake. I believe this KOL is now a robot, or he has a team behind him. He must know what a price drop and a slowdown in growth are. Just like inflation, we can see it in the United States now. There is not no inflation in the United States, but rather a slowdown in the growth rate of inflation. A slowdown in the growth rate of inflation means that prices are still rising, but the rate of increase has slowed down while prices are falling. What is called deflation in the area of inflation, not a slowdown in the growth rate of inflation. So the real estate market is the same, and what he meant by freefall is a decline in prices. However, the overall market price in the United States has not fallen. Only the growth rate has slowed down, and housing prices are still rising. Of course, I can understand that some states and regions have indeed experienced a decline in housing prices. Why? Mainly due to a reversal during the pandemic, when everyone thought they didn't want to return to the office, but now returning to the office, many people are forced to go from relatively small cities to big cities. So let's take a look at this chart, which shows the growth rate of real estate prices in the United States. Actually, we have seen an average annual increase of 5% before the pandemic. So the real estate market in the United States is still very good. It was already very good before the pandemic. In 2021 and 2022, we saw a very exaggerated growth rate, with each year exceeding 15%. In fact, there has been a significant slowdown in this growth rate since 2023. In June of 2023, it once returned to 3%. And at the beginning of 2024, there was a certain degree of rebound. The growth rate has been slowing down from the second quarter of March in the entire 24 years until now in 25 years. The growth rate of this set of data in June slowed down to 2.89, which is close to or even slightly lower than June in 2023. However, a growth rate of 3% still represents an increase in prices, but it has slowed down significantly. This slowdown will also affect the rental market in the future, as well as the housing sector in inflation. Let's take a look at the new housing market in the United States. This is actually the data released a few days ago. In terms of sales in the new housing market, this is an annualized data with 1 month for each year. In fact, we have seen that in the years 24 and 25. And from 23 to 25, almost every sales data is relatively average when annualized and has returned to the level before the epidemic. From the perspective of price, the median selling price did reach a very high position in 2020 and 2021, exceeding 450,000 yuan. In the past 2 years, prices have actually remained relatively stable, ranging from 400,000 to 430,000 yuan. So overall, the U.S. housing market or the U.S. real estate market is in a process of steady growth slowing down. Let's take a look at the New York Fed. Because from this report, we can see the overall health status of consumers in the real estate market or in the mortgage sector. Actually, I shared this chart with everyone a while ago, which was released by the New York Federal Reserve a few weeks ago. We mainly need to pay attention to 3 blocks or 3 lines here. Firstly, what does this image represent? This chart represents the transition to default frequency 30+, which represents the default rate of each loan type at 30 days and the ratio of default rates. The first point I would like everyone to pay attention to is the loan delinquency rate of credit cards. The dark blue line in the graph was released every quarter in the past. In the past few quarters, we have seen that there has been a slowdown in 3 or 4 quarters. And it has basically remained stable. In a downward trend. It represents the delinquency rate of credit cards, which actually peaked more than a year ago. The peak of credit card delinquency rate represents a gradual improvement in the health status of consumers in the entire credit market. From the order of delinquency, it is generally the first to default on credit cards, then on car loans, and finally on housing loans. Therefore, this is the second observation. The dark blue line is indeed higher now than before the epidemic. From the perspective of percentage, we can also understand that there is no problem, even though there has been a slowdown in the past few quarters. It is still higher and worse than before the pandemic, which actually reflects a rift in the current US economy or American consumers. The 4 types of likes are very good and very bad. You add all the good and bad together, the overall consumption level is still okay. Since we are talking about the real estate market, let's take a look at the delinquency rate in the real estate market. The dark blue line represents the drag rate from health status to 30-60 days, or directly to 90 days. We have seen that both the blue and red lines have experienced declines in the past 3 quarters. So finally, let's summarize that the growth rate of the U.S. real estate market is indeed slowing down, and the growth rate of housing prices is also slowing down. But housing prices are still rising, although the increase has indeed been much lower and more reasonable. The latest quarter only saw a year-on-year growth rate of 3%. From the perspective of consumers, it seems that the worst is already behind us, as a delinquency rate in the past few quarters has been moving in a positive direction and not towards an increasingly worse direction. So overall, the housing market in the United States is relatively stable and there are no very dangerous signals to be seen. Finally, today we bring you Investing.com, their summer promotion with explosive discounts of up to 50 on this basis if you use my link to join their membership. You can get an additional 15% discount. In fact, there are apps on the website or app of Investing.com. And there are already many free features on the app or their website. I think everyone can use them. If you don't need them now, I strongly recommend that you use them. Try out their free features. There are many free features that are already very useful, such as a candlestick chart. For example, every time a member of the Federal Reserve speaks, he will tell you in advance at what time, and even during the financial reporting quarter. He will tell you which companies will release their financial reports every day and so on. But today I want to introduce a feature in their membership service called AI Selected Stocks, which mainly uses their AI system to help people select stocks and recommend individual stocks. In history, they have recommended 3 highly successful individual stocks, such as the Time Point recommended by Applevin in October 2024, and the Time Point excluded in December 2024, which rose by 160% in just 2 months, another very important service in investing. Comms Pro service is that many of our viewers do not know where a company's fair value is if they do not have a strong understanding of it. Where is the valuation? To put it simply, where is a reasonable price point for it? Then investing.com will tell us where the fair value is for each individual stock, and whether the current stock price is too high or too low. Finally, their prices come in 2 tiers of services and subscriptions. One is Pro and the other is Pro Plus, priced at $11.49 CAD and $29 CAD respectively. That would be around $8 for the Pro and around $21 - $22 for the Pro Plus. On this basis, it can be further reduced by 15. The Pro section includes the AI stock selection function I mentioned earlier, as well as a PDF file of 1,400 research reports and so on. Could Pro Plus provide more data on top of the previous one, such as financial data from the past 10 years or customizable indicator views? So if you haven't used their website or app before, I strongly recommend that you try their free feature, which is already very powerful, if you are interested in their Pro and Pro Plus membership and services. You can find the link in the comments at the top. That's all for today's episode. Finally, let me mention that this event will expire at the end of August, and there are only a few days left. Okay, that's all for today's issue. See you in the next issue.